Hey everybody, in today's video I'm going to go over what I think is a really important topic, especially if you're a new investor starting out, or if you just want to know what a realistic return looks like in the market. And this can be helpful if someone's pitching you an investment or telling you, hey, you can expect this amount if you invest in this type of stock or this investment, just to know, what's realistic and what's not. And generally speaking, when you're looking at any type of investment, there's no such thing as a guarantee, just because there's always going to be some volatility. But I'm gonna back this up with some numbers and some examples to show you what a realistic return is and why that is the case. So I'm gonna start with Amazon as an example. So this has been one of the best growth stocks to own over the years. Year to date in 2023, it's up about 72%, far better than the S&P 500, which is up by just 19%. So it's been doing really well. But it's also coming off a bad year in 2022 where it had some losses, and so this year it's had to have some layoffs and work on its profitability. And as it's been doing that, the stock's been doing a whole lot better, and people have been buying it up. But it's not a realistic expectation to expect that it's going to be up 70% every year, or even 50% every year. And one calculation that can help you to determine calculate long-term returns on an average is the compounded annual growth rate. And what that tells you is, over the long term, what the investment has averaged, what type of return it's averaged. So, for example, let's say we bought an Amazon stock 20 years ago in 2003. If we go back 20 years, you can see that Amazon stock has gone up more than 5,400%. Right, the S&P 500 by comparison, about 300%. Right, so it's been far and away much better of an investment than the S&P 500. Right, so you've got huge returns on it, but it can be hard to conceptualize. What does that average out to over the course of 20 years? Now you can't just divide it by a factor of 20 because there's the effect of compounding, and so that's what that compounded annual growth rate comes into effect, right? And so to calculate the compounded annual growth rate, what we can do is we take this 5,400 and basically move 2 decimal places over, so it becomes 54, and then we add a 1 for the current value, just so we calculate the growth correctly. For example, if we go year to date, the stock's up 72%, right? So if we wanted to find out how much it's grown, we wouldn't times it by 0.72, we times it by 1.72, right? So that's where we had that 100, that 1 at the beginning. So now let's go back again, 20 years. So again, we got that 54.07. So now we can say 55.07. And now what we're going to do is take the exponent, and then in parentheses, 1 divided by 20. And so the reason we're doing 20 is because 20 years. So if we close that out, we can see that's about 22%. 22% is the long run return that Amazon has averaged over the past 20 years. Right? So that's a pretty strong return. And this is for, arguably one of the best stocks you could have owned over the past 20 years. So if it's averaging 22%, that, if someone's telling you you can get 50%, 60%, or even you can double your money, then, that might be a bit unrealistic. I mean, perhaps in the short term, but usually that's associated with some risk. Like, for example, if you bought the stock, here, where it was down, then, it's achieved significant gains. But in any 1 year, the average is about 22%. And I'll give you a bit more context into that to show you why even this is a bit high. So every year, Berkshire Hathaway, the company that Warren Buffett owns, it posts a shareholder letter, and it also shows you the annual percentage change. So that it shows you their returns versus the S&P 500 when including dividends, right? So you can see their annual returns, and there have been some fluctuations over the years. There's some years, only 4.6%. There's been some strong years, 59, right? Some strong years and some not so strong years. So there's a bit of a mixed bag. And over a period of from 1965 to 2022, it's averaged 19.8%. So that is actually less than Amazon's return over the past, or the compounded annual growth rate that Amazon's been at over the past 20 years. So you're looking at 19.8% for Warren Buffett, one of the smartest investors in the world, probably the smartest. Amazon at 22%. And here you've got the S&P 500 average of 9.9. So around 10% is that annual return from the S&P 500, and that's including the dividends. So you can see that, having an expectation of 30% returns in a given year just really isn't all that probable. If you look at Amazon, it's averaged 22. Berkshire Hathaway's averaged 20. There can be the off year, obviously, like this year. Amazon's up over 70%. There have been years where Berkshire Hathaway's done really well and done more than 20%. We've got 32% here. You've got 57%, 38%. But as you can see, it can be hit or miss. In any one year, here they were down around 20%, 23%, 31%, right? So there's always going to be the chance that over the period of 12 months or so, you could have, a large loss or a large gain, or, something in between, right? There's no guarantee. But over the long term, if you're looking at an investment, I think 10% is a decent benchmark, just because that's sort of like the long-term average of the S&P 500. So anything more than 10% would mean that you're outperforming the index. If you're looking at 20%, you're in Warren Buffett territory, right? You're in Amazon territory, stuff that's been performing exceptionally well. And that's why I think if you're looking at what a realistic return is, I think around 10% is probably what you should aim for. At that rate, you're if there's times where you're above 10%, then you're probably performing better than the market. If you're less than 10%, then a little bit worse. But that's a good goal to have. And one way you can do that is invest in an ETF that mirrors the S&P 500, and it simply follows that. So that way you're never going to be much higher or lower than how the index is done. Finding a stock like Amazon that's generated 5,400% returns over a period of 20 years. I mean, that's extremely unlikely and difficult to do, right? How you can know which stock is going to be the next Amazon over the next 20 years? That's tough to know today, right? So that's where having that expected annual return and knowing what you should expect from a stock can be helpful, just because it can help you gauge how unrealistic a return is or how probable it is. And I think aiming for that 10% return can put it into a bit more context, because as you can see, the S&P 500 hasn't been doing nearly as well. If we adjust that one to say, okay, 4.09 to the power of 1 over 20, then the compound annual growth rate for that is about 7.3%. So it's actually below its long-run average of 10%. So a lot can determine based on the timing of when we're looking at this period at 2003, right? So if we invested at a different time, perhaps the returns would be slightly different. But over the very long term, 10% is a reasonable expectation. I think that's a good benchmark to use when you're looking at stocks or any type of investment.